Welcome everyone to this afternoon session. We are going to deal with Learning Unit 9, Year-End Procedures. In this session, we are going to focus on what is year-end procedures and the procedures or the steps that you have to take. What is very important, this is the last step in our accounting cycle. So if we were to look at the accounting cycle, we capture the transaction in the beginning, and then we would move over to capturing that into the journals. The journals then get summarized into our general ledger accounts. Our general ledger gets summarized or rolled up into our trial balance. Our trial balance then has adjustments to make any corrections for errors, and then that is captured in our financial statements. But before we can finalize our financial statements, we need to do the year-end procedures where we close off all the nominal accounts in order to work out what is the profit or loss for our financial period. Now, the reason we do year-end procedures is to close off our nominal accounts, all our income and expense accounts, to the capital account to actually show what is the worth of the owner at the end of the year, as well as to make sure that we start on a clean slate for the following year so that we know exactly how much profit we made per year and do not work on a cumulative amount. Now let's quickly look at what year-end procedures are. So it's the nominal accounts are closed off against the final account. So the final accounts is temporary accounts. That is your trading account and your profit and loss account to determine the profit and loss for the year. So your nominal accounts are all of your income and expense accounts. That is normally at the bottom section of your trial balance. It is closed off, so it means we are removing it, we are transferring it, we are closing it off by making the use of the double entry system. So remember what we've learned in Learning Unit 2. Do not forget about it. We still applied the double entry system in our year-end procedures as well. Final accounts is new temporary accounts that are created specifically for this purpose in order to finalize our accounts. And the two accounts is your trading account, which is used to calculate the gross profit, and your profit and loss account, which is used to calculate your net profit. Now, your profit is all of your income less all of your expenses gives you your net profit. Okay, whereas your gross profit, again, is your net sales less your cost of sales will give you a gross profit. Now, why do we do this? Income and expenses are for a year, and we are trying to determine the profit for that year. So you don't want to have a longer lifespan than a year, otherwise you would not be able to know what profit I made for a specific year. So therefore we close them off and we start a new income and expense accounts in the next year, but your assets and your liabilities remain untouched. All that gets affected when we close off the income and expense accounts is your equity account, so your capital account, which shows your owner's worth in that specific business. We also have to show how and why by double entries, as always, how we are calculating the profit and how it becomes equity. So calculating it is a maths, but to get it into our books as double entry, we call that accounting. Okay, so the steps you can follow. So there are 8 steps discussed in your textbook. The broad 4 steps that we are looking at is we first determine the gross profit. Now that is broken down into we transfer the sales returns to the sales account. Then we take the sales account to your trading account, which calculates your gross profit. We take our cost of sales to our trading account in order to calculate the gross profit. Once we've done that, we move on to determine our net profit. So the gross profit we've calculated, we then transfer to our profit and loss account. So to determine our net profit, then we transfer all of our income accounts to our profit and loss account, and then we transfer all of our expenses to our profit and loss account, and then we calculate what is the net profit that is calculated. Now in step 3, we transfer that profit to the capital account, to the owner, and then the last one is drawings is closed off to capital to show exactly what is the owner's capital or net worth in that business. Okay, so we briefly discussed how do you determine the gross profit. So let's quickly just go over it again. So step 1, sales returns are closed off to the sales account. So I credit sales return, I debit sales. So our sales amount is reduced. Then sales is closed off to the trading account. So I debit sales and I credit the trading account. Then cost of sales is closed off to the trading account. So I debit cost of sales and I credit cost of sales and I debit the trading account. And the balance of the trading account equals to our gross profit. When determining the net profit, all of our other income and expense accounts are involved. And the two accounts that you will be using in order to work out your net profit is the trading account by moving the profit we previously calculated to your profit and loss account. And then your profit and loss account is where we remove all the income and expenses to in order to work out the net profit. So in order to move the previous profit, the gross profit, to our profit and loss account, we debit the trading account and we credit the profit and loss account. If we want to remove the income, we debit every income account and we credit the profit and loss account. And to remove all the expenses, we credit every expense account and we debit the profit and loss account. Once you are done with this process, there should be no nominal accounts left. The balance of the profit and loss account is given to the owner, so that the profits that is made within a business goes to the owners. So what we do now is we debit or credit the profit and loss account depending on whether we've got a profit or loss, and then we credit or debit the capital depending on what we made. This is the first time in the year where we see how profit becomes equity and how the owner is entitled to the profits of the business. So we are moving the profit that they've earned to their capital to show what is their equity in their business. So it's very important for any type of business form. It doesn't matter whether it's a sole proprietor, whether it's a Pty Limited, a CC, we will always transfer the profit to their equity accounts. Then the last one is drawings is closed off to capital. So drawings has a negative effect on our total equity. It's because it's money we have drawn from our business. And because of our year end, we're trying to complete the picture. And part of this is summarizing the drawings onto equity to show what is our actual worth in the business. So we offset it against the capital account to work out how much capital does that owner physically have in the business. Okay, so when you close off the balance of your capital, you've got your opening balance plus any profit minus any drawings gives you your closing balance of capital. Okay, before we move on to a question, do you guys have any questions on this?